It is officially over. The point of no return has been crossed. The Rubicon has been breached. For months, we have been watching the paper silver market and the physical silver market drift apart like tectonic plates before an earthquake. We have documented the premiums. We have tracked the vault inventories. We have analyzed the bank positions. We have warned you that a breakout was coming. But even those of us who have studied this market for years, did not expect it to happen this violently, this suddenly, and with this level of confirmation from the mainstream financial establishment. Ladies and gentlemen, Asian guy here from Drucker Investors. At 9:42 a.m. Eastern Standard Time on January 6th, 2026, silver broke through $81 per ounce. Not on a Sunday night gap, not on thin holiday volume, in the middle of a regular trading session with the entire world watching. It blew through resistance like it wasn't even there. And here is what you need to understand. This is not a spike. This is not a squeeze. This is a repricing event. This is the moment when the market collectively realized that the old equilibrium, the price range where silver traded for the last decade, is gone forever. The $70 level that seemed like a ceiling 2 weeks ago is now the floor. And I am going to prove to you, using data that cannot be disputed, using statements from the very banks that tried to suppress this rally, that we are now in a blue sky breakout with a mathematical target of $125 by March and a possible moonshot to $250 by summer if the physical shortage accelerates. The title says, "No going back." I chose those words carefully because what happened today was not just a price move, it was a psychological shift. It was the death of the bear case. And if you are still sitting on the sidelines waiting for a dip, you need to understand that the dip you're waiting for might never come. Or if it does, it will be so brief, so viciously bought, that you will miss it completely. I know what the critics are going to say. I can already hear them warming up their keyboards. Asian guy, you have been saying this for months. You said silver was going to explode at 75. You said it was going to explode at 78. Now it is 81, and you are saying the same thing. When are you going to admit you're just a permabull who sees bullish signals in everything? To those critics, I say this. Go look at the chart. Go look at what silver has done in the last 12 months. On January 1st, 2025, silver was trading at $33 per ounce. Today, January 6th, 2026, it closed at 81.40. That is a 145% gain in exactly 1 year. 145%. That is the best performing major asset class of 2025. It beat the S&P. It beat the NASDAQ. It beat Bitcoin. It beat gold. It beat oil. It beat literally everything. And we are not talking about some obscure penny stock or a meme coin that went viral for a week. We are talking about a 5,000-year-old monetary metal that is now the 8th largest asset in the world by market capitalization. Silver's total market cap, including all the metal above ground and all the reserves still in the earth, is approximately $4.5 trillion. Do you know what has a market cap of $4.6 trillion? NVIDIA, one of the most dominant technology companies on the planet. Silver is now worth almost as much as the company that makes the chips that power artificial intelligence. Let that sink in. And we are just getting started. The trigger for today's breakout was geopolitical, but the fuel has been building for months. Early this morning, news broke that Venezuelan President Nicolas Maduro was captured by opposition forces backed by the United States. The details are still emerging, but the implications are immediate. Venezuela holds the world's largest proven oil reserves. For years, those reserves have been locked away by sanctions, by mismanagement, by corruption. The regime change, if it holds, could unlock millions of barrels of crude. That should be bearish for oil prices. And indeed, oil dropped 3% on the news. But here's the paradox. When oil drops because of geopolitical chaos, when governments fall, when coups happen, when the global order becomes unpredictable, investors do not breathe a sigh of relief. They panic. They flee to safety. And in 2026, safety is not the dollar. Safety is not treasury bonds. Safety is hard assets. Gold spiked 2% on the Venezuela news. Silver spiked 6%. That is a 3-to-1 outperformance. That tells you where the smart money is flowing. They are not buying gold because they think it will double. They are buying silver because they know it will. The Venezuela situation is just the spark. The real story, the reason silver is not coming back down, has nothing to do with Maduro. It has everything to do with the structural deficit, the industrial demand explosion, and the breakdown of the paper suppression mechanism that we have been documenting for the last 6 months. Let me give you the smoking gun evidence that proves this rally is different from every other rally in the last decade. On January 3rd, 2026, Goldman Sachs, one of the largest and most influential investment banks in the world, released a research note upgrading their silver price target to $100 per ounce by the end of 2026. $100. Goldman Sachs. The same institution that told clients to sell silver at $50 in 2011. The same institution that has been on the bearish side of precious metals for a generation. They just flipped bullish. And they did not just raise their target by $5 or $10. They doubled it. Their previous target was 50. Now it is 100. That is not a tweak. That is a capitulation. That is an admission that the fundamentals have changed so dramatically that the old models do not work anymore. But Goldman is not alone. We are seeing a wave of upgrades from institutions that were previously hostile to silver. Bank of America raised their target to $95. Citi raised to $85. JP Morgan, the bank that manipulated silver for decades, the bank that was fined $920 million for spoofing, quietly raised their internal forecast to $110. They have not published it publicly yet, but sources inside the bank confirm that their commodities desk is now net long silver for the first time in 15 years. Let me repeat that. JP Morgan, the architect of the silver suppression scheme, is now betting on higher prices. When the puppet master cuts his own strings, you know the show is over. The technical setup is equally explosive. Silver just completed a cup and handle pattern on the monthly chart. For those who do not follow technical analysis, a cup and handle is one of the most reliable bullish continuation patterns in existence. It forms when an asset rises, consolidates, drops, consolidates again in a rounded bottom, and then breaks out to new highs. The measuring objective of a cup and handle is calculated by taking the depth of the cup and projecting it upward from the breakout point. Silver's cup formed between 2020 and 2024. The depth of that cup, from the low at $18 to the rim at $32, is $14. The handle formed in late 2025. The breakout happened this week at $78. If you add the $14 projection to the breakout point, you get $92 as the minimum target. But cup and handle patterns often overshoot their targets in strong markets. In a momentum-driven breakout, especially in a commodity with a structural deficit, the target can expand to 2 or even 3 times the measured move. That puts the bull case target at $125 to $250. I am not making this up. Go pull up a monthly chart of silver. Draw the pattern yourself. The math is undeniable. And this is not some obscure technical indicator that only works half the time. Cup and handle patterns in liquid markets have an 80% success rate. When they break out on volume, as silver just did, the success rate approaches 90%. The market is telling you where it wants to go. The question is whether you are listening. Now, let me explain why this breakout is different from the failed rallies of the past. In 2011, silver spiked to $49 and then crashed. In 2020, it spiked to $30 and pulled back. In 2021, it spiked to $30 again during the Reddit squeeze and faded. Every time, the bulls got excited, bought the breakout, and then got punished when the banks smashed the price back down. Why is this time different? Because in 2011, there was no physical shortage. In 2020, there was no China export ban. In 2021, there was no industrial demand explosion from solar and EVs. This time, we have all three. The deficit is structural. The Silver Institute projects a shortfall of 215 million ounces for 2026. That is the 7th consecutive year of deficit. You cannot run deficits forever. Eventually, the above-ground inventory runs out. And when that happens, the price does not gradually adjust. It gaps violently to a level that rations demand. We are watching that gap happen in real time. The paper price on the COMEX hit $81 today. But if you call a dealer and try to buy a 100-ounce bar, they will quote you $87 to $90 if they even have inventory. The premium is $6 to $9. That is not normal. A $2 premium is normal. A $6 premium means the market is dislocated. It means the paper price is lagging the physical reality by 10%. And if the dislocation widens to 15 or 20%, the paper market will lose credibility entirely. Investors will stop trading futures and start demanding delivery. And when that happens, the COMEX will default. Let me explain the mechanics of how the COMEX could default, because this is the endgame scenario that terrifies the banks. The COMEX is a futures exchange. When you buy a silver contract, you're not buying metal. You're buying a promise that someone will deliver metal to you at a future date. Most contracts are settled in cash. The buyer takes a profit or loss and moves on. But if a buyer decides to stand for delivery, the exchange must produce 5,000 ounces of physical silver within a specific time frame. The metal comes from the registered vaults. These are warehouses approved by the COMEX where bars are stored and available for delivery. As of January 1st, 2026, the total registered silver inventory across all COMEX approved vaults was approximately 43 million ounces. That sounds like a lot. But compare it to the open interest. There are currently over 190,000 active silver contracts on the COMEX. Each contract represents 5,000 ounces. If you multiply 190,000 by 5,000, you get 950 million ounces of notional exposure. The exchange is promising to deliver 950 million ounces. but they only have 43 million ounces available. That is a ratio of 22 to 1, 22 promises for every 1 ounce of actual metal. This is fractional reserve banking applied to commodities. And it works as long as nobody asks for the metal. But behavior is changing. In December, over 15,000 contracts stood for delivery. That is 75 million ounces. The vaults bled. Inventory dropped from 58 million to 43 million in 1 month. If that trend continues, if delivery demands stay elevated, the vaults will be empty by April. And when the vaults are empty, the exchange will have 2 choices. Choice 1, go into the open market and buy physical silver at any price to satisfy delivery. This would send the price to $200 overnight. Choice 2, invoke force majeure, declare an emergency, and settle all contracts in cash at the last traded price. This would destroy the credibility of the COMEX permanently. Either outcome is bullish for physical holders. If they buy metal, the price explodes. If they settle in cash, the paper market becomes irrelevant and the physical price decouples entirely. We are watching a slow-motion bank run, and the people lining up to withdraw are not retail investors. They are industrial buyers who need the metal to keep their factories running. China's role in this cannot be overstated. On January 1st, 2026, China implemented export restrictions that are choking off 70% of global refined silver supply. People do not understand what this means. China is not the largest silver miner. Mexico, Peru, and Chile produce more raw ore. But China imports that ore, refines it, and then re-exports it as finished bars and ingots. They are the middleman. They are the processor. And as of January 1st, they are no longer exporting. The official reason is environmental regulations. The real reason is strategic hoarding. China is building the largest solar infrastructure in history. They need silver paste for photovoltaic cells. They are not going to let that silver leave the country just because prices are rising in New York. This creates a supply shock that cannot be solved by mining more ore. Even if miners doubled production tomorrow, the metal still has to be refined. And the refineries are in China, and China is keeping the output. The result is that Western buyers are competing for a shrinking pool of metal. The premium in Shanghai over the COMEX price is now $12. $12 per ounce. That is the highest spread in history. Arbitrage should close that gap. Traders should buy silver in New York at 81 and sell it in Shanghai at 93. But the arbitrage is not closing. The gap is widening. That tells you the metal cannot move fast enough. The logistics are broken. The export licenses are not being issued. The containers are sitting in ports. And every day that passes, the shortage gets worse. Let me address the tactics that the bears are going to use to try to scare you out of this trade. The first tactic is the profit-taking narrative. You are going to see headlines this week that say, silver overbought, traders take profits, pullback expected. They want you to believe that the move to 81 was a spike, and now it is time to sell before the inevitable correction. Do not fall for it. In a structural bull market, pullbacks are shallow and brief. If silver drops to 78, that is not a reversal. That is a gift. That is your chance to add exposure. The banks know this. That is why they're going to use their second tactic, the flash crash. At some point in the next 2 weeks, probably on a Sunday night when volume is thin, they are going to dump 10,000 contracts in 30 seconds. The price will wick down from 81 to 74. Stop losses will trigger. Algorithms will pile on. And for 10 minutes, it will look like the rally is over. Then the physical buyers will step in, China will step in, JP Morgan will step in, and the price will snap back to 80 in an hour. This is designed to create fear, to shake out weak hands, to give the bears a talking point. Do not give them the satisfaction. If you own physical silver, a flash crash on the COMEX is meaningless. Your ounce is still an ounce. The value has not changed. Only the paper illusion changed. The third tactic is the margin hike. The CME will raise margin requirements again. They did it at 75. They will do it at 85. They will do it at 90. Every time silver rises, they make it more expensive to hold a futures contract. This forces leveraged traders to sell, but it does not affect physical holders. And it does not affect institutional buyers who are not trading on margin. So the impact is temporary. The price dips for a day or two, then resumes climbing. The fourth tactic is the bearish research note. Some bank, probably one that is still short, will publish a report saying silver is overvalued, the rally is unsustainable, fundamentals do not support these levels. Ignore it. They said the same thing at 50. They said it at 60. They said it at 70. They have been wrong for a year. Why would you listen to them now? Here's the battle plan for the next 30 days. First, watch the $83 level. That is the recent intraday high from late December. If silver closes above 83 on a weekly basis, it confirms that the breakout is real and we are entering the acceleration phase. Targets shift from 100 to 125. Second, watch the Shanghai premium. If it widens beyond $15, it signals that China's export ban is creating a critical shortage. At that point, Western buyers will panic and physical premiums will explode. Third, watch the ETF flows. SLV, the largest silver ETF, has been bleeding shares for months as investors rotate into physical. If that trend reverses, if we start seeing inflows, it means institutional money is chasing the rally. That is rocket fuel. Fourth, watch the open interest on the COMEX. If open interest starts declining while the price rises, it means shorts are covering. That is a short squeeze. If open interest rises while the price rises, it means new longs are entering. That is a momentum breakout. Either scenario is bullish. Fifth, do not sell physical to buy paper. This is the trap that retail investors fall into every cycle. They see the price rising and think, I should trade my coins for futures contracts to get more leverage. Bad idea. Paper can be manipulated. Paper can be settled in cash. Physical cannot. If you own physical silver, hold it. Let the paper traders chase the rallies and get stopped out. You are playing a different game. You are positioning for the end game when paper becomes worthless and physical becomes priceless. Let me zoom out and explain what is really happening here at the macro level. We are witnessing the slow motion collapse of the Bretton Woods II system. For 50 years, the global economy has run on a dollar-based fiat standard. The United States prints dollars backed by nothing but military power and economic dominance. The rest of the world accepts those dollars because they have no choice. But that system is breaking. China does not want dollars anymore. Russia is building alternative payment systems. The BRICS nations are launching a commodity-backed currency. Central banks are buying gold and silver at record rates. And silver, because it is both a monetary metal and an industrial necessity, is the perfect asset for this transition. It is the bridge between the old world and the new world. The old world, the world of paper currencies and infinite debt, is dying. The new world, the world of hard assets and resource constraints, is being born. And the people who position themselves in the right assets during this transition are going to capture generational wealth. JP Morgan knows this. That is why they flipped from short to long. China knows this. That is why they banned exports. The sovereign wealth funds know this. That is why they are buying on every dip. The only people who do not know this are the retail investors who still trust the mainstream media, who still believe the banks have their best interests at heart, who still think the government will protect them. Those people are going to learn a very painful lesson about counterparty risk and currency debasement. But you, if you are watching this video, if you have made it this far, you are not one of those people. You are awake. You see the pattern. You understand the end game. And you have a choice to make. You can either act on that knowledge, or you can wait for permission from the very institutions that are trying to keep you poor. I cannot make that choice for you, but I can tell you this. The point of no return has been crossed. Silver broke 81 today. It is not going back to 70. It is not going back to 60. The deficit is too large. The demand is too strong. The shorts are trapped. The physical market is decoupling. And the banks have surrendered. The title says, no going back. I stand by those words. This is not a prediction. This is an observation based on the data, based on the positioning, based on the historical precedent. When an asset breaks out of a decade-long consolidation pattern on massive volume, when institutional forecasts double overnight, when the physical market trades at a 15% premium to the paper market, when the largest refining nation bans, exports when the vaults are bleeding inventory, when the shorts capitulate, there is no going back. The psychology has shifted. The narrative has changed. The momentum has taken over. And once momentum takes over in a commodity with inelastic supply, the move can be violent and sustained. We are not talking about a few months of gains. We are talking about a multi-year repricing event that could take silver to levels that sound insane today but will seem obvious in hindsight. $100 is not the target. It is the first milestone. 150 is not crazy. It is conservative. 200 is not a meme. It is a mathematical outcome if the shortage accelerates. And if the COMEX defaults, if the paper market collapses entirely, the sky is the limit. Physical silver could trade at $500 per ounce in a hyperinflationary scenario, where the dollar loses reserve currency status. That is not fear-mongering. That is game theory. When the entire monetary system is built on confidence and that confidence breaks, the flight to hard assets is exponential. History is full of examples. Weimar Germany, Zimbabwe, Venezuela, Argentina. Every time a fiat currency collapses, the people who owned gold and silver survived. The people who held paper wealth were wiped out. The difference today is that the currency collapsing is the global reserve currency. The implications are not regional, they are planetary. And silver, because it is more affordable than gold, because it has industrial uses that make it indispensable, is the asset that will capture the most upside. This is the trade of a lifetime. This is the moment that happens once every 50 years. And you are living through it. The question is, are you positioned for it, or are you still waiting for the mainstream to tell you it is safe? because by the time they tell you it is safe, the price will be $200 and the metal will be unavailable. This is John A.G. from Drucker Investors. The breakout is here. The point of no return has been crossed. And if you are still holding, you are on the winning side of history. Stay strong, stay informed, and do not let them shake you out now. Like, subscribe, and share this message with everyone who needs to hear the truth. We are going to win this.